coverage ratio. So debt service coverage ratio. Okay, so what is a coverage ratio? Coverage ratio means, okay, the coverage ratio measures the firm's ability to service the fixed liabilities. Okay, so it firm's ability to service fixed liabilities. So what are the fixed liabilities? The fixed liabilities means your recurring fixed expenses on debt. So that includes your interest on loans, then your preference dividend, then amortization of principal or repayment of installments of loans, okay, or redemption of debentures or preference shares on maturity. Okay, so all these are the firm's ability to service the fixed liabilities, that is counted by your coverage ratio. Okay, now let's see debt service coverage ratio. So debt service coverage ratio. Okay, so debt service coverage ratio is earnings available for debt service, okay, divided by interest plus installments. Okay, so earnings means your earnings in your profit and loss account. Earnings available for a debt service divided by interest plus installment of the loan. Now earnings available for debt service means the earning for that specific period which are available for your debt service. Now let's calculate what is earnings for a debt service. So earnings for debt service, okay, is equal to your net profit, okay, plus non-cash operating expenses like depreciation or amortization. Okay, so basically what you want to get is you want to get your cash operating profit. Okay, so you are adding back your non-cash expenses like depreciation or amortizations. Okay, so for this what you need is profit which the firm normally earns from its operation. Okay, that is why you are adding back this non-cash expenses like operating expenses like depreciation or amortizations. Okay, plus non-operating adjustments, okay, like loss on sale of assets. Now loss on sale of asset is not a transaction which is taking place regularly, okay, and that's not a main operating business of the firm. So we will make some adjustments which are of non-operating nature so as to get a operating profit, like loss on sale of fixed assets, okay, plus your interest on debt fund. Okay, so since we are calculating earnings available for debt service, what we are doing is we are adding all non-cash expenses, okay, non-cash operating expenses plus non-operating adjustments like loss on sale of fixed asset and plus interest, because we need to know what is a net profit, cash operating net profit, that is profit which is normally earned from his operations, okay, before depreciation and interest. Okay, that is what we want to know. That is why all this adjustment need to be made before calculating debt service coverage ratio. Now we'll see one example. So this is the example, okay, in the books of XYZ profit and loss account for the year ended 31st March 2017. Okay, so to administrative expenses 3 lakh, to selling and distribution expenses 1 lakh, to interest 50,000, to loss on sale of fixed assets is 12,000, to goodwill return of 15,000, to tax provision is 4 lakh 12,000, and then to net profit is 4 lakh 13,000. Okay, then on right hand side you have gross profit after charging depreciation of 1 lakh, so 1 lakh 25,000, so it has a depreciation of 1 lakh rupees. Okay, so 12 lakh 50,000, I'm sorry. Then by income of investment is 50,000, my miscellaneous income is 2 lakh. So this is a profit and loss account of XYZ Limited. Now we have to calculate what is debt service coverage ratio. Okay, so your debt service coverage ratio is equal to earnings available for debt service upon your interest plus installment. Okay, now let's calculate what is earnings available for debt service. Okay, so earnings available for debt service. We will begin with the net profit which is given here, and we will calculate it in the reverse manner. Okay, so net profit, so how much is the net profit? 4 lakh 13,000. Then there are certain things which we have to add back, right? What all we need to add back is, first is non-cash operating expenses, right? So what are the non-cash operating expenses here? Let's see the profit and loss account. So non-cash operating expense, one is goodwill return of 15,000. So goodwill return of 15,000. Then if you see carefully, your gross profit has a depreciation of 1 lakh rupees, so we have to add back that. So depreciation, okay, included in gross profit, 1 lakh. Then we have to add back all non-operating adjustments. Okay, so what is a non-operating adjustment which is given here? One non-operating adjustment which is given here is loss on sale of fixed assets, so we have to add it. Sale of fixed assets. How much is that? Loss on sale of fixed assets is 12,000, right? So this is a non-operating adjustment, right? Then this is non-operating adjustment. Then what we have to add is your interest, Okay, interest expense, because we want to know what is a profit before paying of your interest. So interest expense, so how much is the interest expense? Interest expense is 50,000, so we will add back 50,000. Okay, so now if you add all this, what you will be getting is 5,90,000. Okay, now 5,90,000. Now your debt service coverage ratio will calculate. Okay, it is numerator you have earnings available for debt service, that is 5,90,000, divided by your interest plus installment. Now interest is 50,000, which is given in your profit and loss account. Okay, now installment is given, current installment of the loan is 5 lakh, so divide by 5 lakh, that is installment plus 50,000. Okay, so it comes to 1.07. Okay, so your earning available for debt service is 1.07 times as compared to your installment plus interest, right? So it will be able to cover your installment payment plus interest payment, right? So this is how you calculate your debt service coverage ratio. Okay, thank you.